Hello, and thank you for joining us at exam.com for this special report. We'll be looking at gold, which traditionally is considered a safe haven. It gains in an environment of political unrest and high inflation, but that hasn't been the case this tumultuous year. But are the fortunes changing for bullion? I'm Christina Marujos. Joining me today is our senior investment analyst, Charalambos Pissouros. Charalambos, we've seen gold decline this year, even as inflation hit record highs across the globe. Why has this narrative changed, do you think?
Hello, Christina. Usually, gold wears its safe haven suit and acts as an inflation hedge during periods when central banks are cutting interest rates to boost economic growth and revive inflation. In recent years, central banks accompanied their easing policies with massive bond purchases, which assisted in dragging yields down. Therefore, in a zero-yielding environment, the precious metal may have been the asset of choice within many portfolios. Now, the picture is not aligned with that normality. Yes, the global economy is on the verge of recession, but with inflation getting out of hand, central banks around the globe have been setting the fight against inflation as a priority rather than the restoration of economic activity. Thus, as interest rates around the globe rose at a fast pace this year, the non-yielding gold lost its allure. The title of the ultimate safe haven was passed to the US dollar, as with the Fed raising interest rates more aggressively than other major central banks, it became the only safe haven currency that also offers high yields. Gold has therefore developed a positive relationship with equities and a negative one with the US dollar.
However, it looks like the precious metal is gaining ground recently. Only in November it managed to add 10% to its value. Are we looking at a trend reversal for gold?
To examine that, we need to understand why gold gained this month, and my answer to the first question makes it easier. Expectations with regards to aggressive tightening by the Fed have notably eased recently, especially after data showed that US inflation slowed by more than expected in October. Market participants are now nearly fully convinced that the committee will proceed with a smaller 50 basis points hike in December after delivering 4 consecutive 75 basis points increments, and they are pricing in almost 2 quarter-point rate cuts by the end of 2023. This shift in market expectations has weighed on Treasury yields and the US dollar, thereby helping gold to rise by more than 10%. Now, the big question is whether the recovery could continue for longer. Further data and remarks supporting the case of a less aggressive Fed may indeed help the precious metal to sparkle more. However, the market's pricing seems more dovish than recent Fed communication. Although most officials agree that slower rate increases may be appropriate hereafter, some of them have been holding the view that when interest rates hit their terminal level, they are likely to stay there for a while. Therefore, developments pointing to even a slightly more hawkish rate path compared to the one anticipated by the market could well revive bond yields and the US dollar and thereby bring gold under renewed selling interest. So, the current rebound may only be a large upside correction which could get extended rather than a full-scale bullish reversal.
Charalambos, thanks so much. This was a special report on gold here at exam.com.